Hello, everybody, and welcome to the Tortoise channel. And today, I want to talk about a recent interview with Terry Smith. He went to a podcast not long ago, and I want to break down the main insights, right? So the main lessons from that episode. And as always, you know that I put everything into a document that I already shared with my community, and I want to do it right here as well. Okay. Now we have a lot of things to cover, but before I do that, I want to say that, and you will probably see that the way we structured our channel, you can see that we just divided this into different categories. So I'm aiming for 20+% returns, and there is a section that is called investing education. And recently, I just put a video here from one of our technical analysis group sessions. It was awesome, and the reason I'm pointing this out to you guys is because this channel is all about fundamental analysis. I can't stress how important fundamental analysis is. That said, we use technical analysis as a complementary tool. Okay, so let's say our approach to investing is 90% fundamentals and 10% technicals. If you've been following us, you know that this is exactly what we do, especially if you are one of our clients. Okay, so yes, only after we do our due diligence from a fundamental standpoint do we then jump into the charts and see if there is a way we can capitalize if we can maximize our upside while minimizing our downside. That said, it's not even mandatory, okay? Because if you do the due diligence correctly, if you do your fundamental analysis properly, you won't even need technical analysis, okay? So I want to point that out. But because some of you reached out to me, I decided to create a session on technical analysis because one of our members, she also does technical analysis, and so she was the best person definitely to give us a session on that, and it was pretty good, very insightful. So not all of our members managed to join, but still, it was. I found it very insightful, and she broke down complex concepts in a digestible manner, which is definitely very, very good. So yeah, just a quick highlight of the week, just to share with you here, guys. Okay, so if you want to watch the video, just go for it and see if you like it, or not. If you like it, just smash the like button. If not, well, just leave a comment so we can take that into account for our next video. Okay, awesome. Again, I'm running out of battery, so bear with me 1 second. Technical issues. Okay, here we go. Right, so on to Terry Smith, guys, and you can see he is right here, the big man. And this is the. I mean, feel free to, of course. I mean, it's online. You can listen to the podcast as well, to the episode. The title of the episode is Terry Smith on quality investing and how to become a billionaire. I listened to it and just highlighted the main points. Okay, and so you can find them right here, and I will present them to you right now, and hopefully you will manage. You will immediately recognize some of the philosophies that Terry Smith strongly abides by, because we like to follow the same playbook. Okay, but even though we don't agree with everything that he does, but we will touch upon that as we go along this document. Okay, so let's continue. So the way I title this lessons from a decade of quality investing, Underperformance and discipline. Okay, so Terry Smith spoke candidly in a recent interview about success, failure, market distortions, and why sticking to a sound framework matters more than ever. And just to give you context, Terry Smith and his fund, Fundsmith, have been under fire over the last few years because they have been underperforming the market averages. And what do I mean? I mean that they have been underperforming for the last 5 years, which is quite significant. Okay, and as you probably expect, when you have been lagging the indexes, the main indices for such a long time, that really dents your returns. And that has been the case. Not long ago, I believe, when I looked at this performance, it was at about 15% annualized returns. Now it is under 14%. Okay, so of course, I mean, look, It's still above 13% or close to 14%. However, I mean, understandably so, people are becoming impatient. But I have to. I have to take my hat off to him because he sticks to his guns and I really like that. So, what did he say on number one? He discussed his drive, ambition, and the will to try. Right, attributes much of his success to a deep desire to succeed and to be the best. Failure, ridicule, and criticism are part of the journey by not trying is worse. I just love that because I live by this. This is exactly what caused me to start a business and to just to face all the headwinds of entrepreneurship because I knew that at the end of the day, even if things didn't work out as expected, I could always go back to my previous job, and that's what it is. But if you don't try, you will never know. So I love that. Okay, at least if you try, you will learn. For example, right now I've learned a ton, and it's so amazing, guys, because entrepreneurship, and we can talk more about this as well in future videos. But I mean, I find it fascinating how big a contrast so I find it fascinating how big a contrast you will find so between entrepreneurship and investing. As an entrepreneur, we essentially need to be actives because we will find ourselves juggling many different commitments, right? I have to understand marketing, I have to understand sales, I have to understand the core of my business, which is investing, of course. And I was so wrong initially. I thought, oh, okay, so in order to succeed, all I have to do is to share my track record, and people will just, jump at me. And it doesn't work like that. So you need a process as well, and you need to understand business. Okay, and that means understanding a lot more than just investing. In my case, but invest as an investor. Activity will actually hurt your returns down the line. So I mean, you have to balance these out, okay? And they both require very different skills, but you can be successful at both. But many successful entrepreneurs fail at investing exactly because they lack the other side of so they lack certain skills. For example, the ability to remain patient in not doing anything. Okay, so anyway, let's continue here. I digressed, but I think it's important for you guys to understand as well. Lower future returns are likely. Okay, he pounded a table on this thing. So the free cash flow yield of the fund Smith portfolio has fallen from roughly 7% historically to about 3%. So the interviewer actually pointed this out. And then he asked him, "Listen, do you think this means lower returns for your shareholders down the line?" And what Terry Smith said very openly is that, yeah, maybe. So this implies that future returns are unlikely to match the exceptional returns investors enjoyed in the past. A reminder that valuation always matters, even for great businesses. And so, and he also said that, look, there are some things we cannot control, right? So, for example, if the growth rate of some of the businesses that they own suddenly explodes, of course, then this will bode very well for his portfolio. But yeah, just take that into account that the cash flow yield declined from 7% to about 3% today. Okay, and another reason is due to his capex. So some of his major holdings include, for example, Meta and Microsoft, and you know that all these companies have been so they are plowing a lot of money into data centers and so forth, and so the free cash flows have been depleted, right? And that causes the free cash flow yield over the overall fund to come down, because only between those two names, for example, that he has about what 15% or a 20% portfolio allocation, and so yeah, just take that into account, okay? Now, selling Diageo, which is a beverage company. Quality, why did he sell? Quality is not enough Fund Smith exit, so quality is not enough. Fund Smith exited Diageo due to mounting secular headwinds in the alcoholic beverages industry. And as you guys know, some of you pointed out, why don't you? In fact, I believe I covered Diageo in a recent video. No, excuse me, it wasn't Diageo, it was Constellation something. And the reason I didn't invest in it is because I see the secular headwind that Terry Smith is talking about here, right? So we can see that people are drinking less alcohol, and chances are this trend will continue going forward. Look, I mean, so I don't have an edge here. If you understand the industry better than me, then for sure, I mean, you are onto something. I just prefer to stay away, not least because I'm not into alcohol. All right. So even high quality businesses can become unattractive if long-term structural trends turn against them. Very, very important here. Very important lesson. 5 years of underperformance, here we are, and why this happens. Fundsmith is now in its fifth year of underperformance versus the broader market. Terry stressed that underperformance is inevitable at times. Very true. Even the best performing funds in the most successful investors in the world, they typically underperform every now and then. What matters is the long term, but still, 5 years of underperformance, you can make the case that this is already certainly medium term, not just short term. The key is introspection without abandoning a proven framework or chasing what's currently working. And they've done a lot of introspection as well, as he discusses. However, he also mentions that the real causes of underperformance include some of the following things that we are about to cover. But first, what truly causes him stress? I have a lot of sympathy for him because I understand how difficult it may be at times to manage those emotions. Right? Look at that. Market volatility doesn't keep Terry up at night, but letting investors down does. And he will is be facing criticism, and this will likely persist while that underperformance continues to drag on. Okay. Why quality has struggled recently? So these are, according to him, the root causes of his underperformance. Several power headwinds have weighed on Fundsmith's. Several power headwinds have weighed on Fundsmith's performance. Rising interest rates, which of course hurts quality strategies that resemble long duration assets. What does that mean? It means that in a rising interest rate environment, the companies that typically tend to perform well include, for example, more cyclical businesses like, for example, banks and in other sectors that he also flagged, both of which he doesn't like to invest in. Okay, but however, this hurts quality strategies, and Terry Smith is a quality investor. Strong performance of cyclicals and financials, here we are, which Fundsmith avoids. So, for example, banks, right, one of them, and also look how the precious metals market and the commodities market has been on an absolute tear over the last 3 years or so. Yeah, with metals breaking new all-time highs almost on a daily basis. All right. And so the dominance of but this is not only due to rising interest rates. In fact, it's not so. With regards to precious metals, because interest rates are rising, you would expect metals to actually come under pressure. But the problem is interest rates are rising to fight inflation. And it's inflation, persistently higher inflation, that is causing precious metals to go ballistic, on top of all the geopolitical instability we see around the world. Okay, that's it. So the dominance of the Mag 7, which happened around 2023, all right, and then of course the surge of AI related speculation in 2024, and last but not least, he also points out points out a massive rise in index fund flows, which Terry Smith argues now resemble a momentum strategy more than anything else. What does that mean, guys? I've mentioned this in previous episodes of this of our channel. This what is saying right here. I will talk about these distortions right here as well. But what he's saying right here is that when you buy into the S&P 500 index, is capital is so is cap. How can I say is ca- is ca- market capitalization weighted. That's what I wanted to say. And so the largest companies in that index, they are the largest companies by market cap. And what happens is when you buy the index, you are actually investing in companies that have the largest capitalization in that index, and they include, of course, the Nvidias, the Microsoft, the Metas of this world. And what that leads to is to massive capital. What that leads to is massive capital distortions, right? So capital is flowing into the largest companies regardless of valuation or even quality. Look how many quality companies have been going ballistic without having any solid fundamentals to back up that stock price momentum, creating distortions across markets. Very important. Market distortions can lead to what? Can lead to several years of underperformance. Look, Terry reminded investors that the extreme distortions, like the ones we saw during the dot-com bubble or Japan's equity market, can result in decades of poor returns. Right, so Japan, for example, took roughly 25 years to recover. That only happened in 2024, I believe, when the Nikkei finally crossed the previous all-time high reached 24 or 25 years ago. I mean, absolutely unbelievable. Recessions are painful but necessary. I found this very interesting and I completely agree. Terry Smith is a capitalist. He mentioned that in the podcast as well. I'm a capitalist, and I believe that I believe in the power of creative destruction, right? So he believes that we are long overdue for a major recession, noting that the last true one occurred during the global financial crisis 16 years ago. Capitalism requires creative destruction, even if it is uncomfortable. Yes, a lot of people will suffer the consequences, especially those that have, that have been gambling in the stock market for the last several years. But the sheer amount of misallocations that that several years of close to zero, of near zero interest rates have caused. What this means is that there has been a lot of misallocation of capital, plenty of distortions across all assets, not just stocks, but also real estate, in so on and forth. And that capital needs to be reallocated to more productive means. Okay, so to have a recession that will clear that a recession that will clear all these excesses will actually be a panacea, if you ask me. Overvaluation doesn't mean imminent collapse. He mentions that, right? So while the market appears expensive, no, I mean, there is no way we can predict that the bubble will bust next year. So he acknowledges that valuations can stay elevated for longer than expected. Another reminder of humility in forecasting. And I, I'm a big advocate of that, right? So we have to be humble, because the market will punish us if we are not humble. We are not in the business of predicting the next market crash. We are in the business of making sound investment decisions while working probabilities to our favor. And look, I know there will be a crisis, a stock market meltdown, a real estate meltdown, but I have no idea when these things will happen. And that's why I will remain investor, because as you well know, if you are following the channel, far more money have been lost by investors trying to predict the next recession than in the recessions themselves. And I'm quoting Peter Lynch here, okay? And so we want to remain invested in high quality companies, but only once we have a margin of safety, which is very difficult, right? The combination of these two is very difficult to find in such an expensive market as this one. All right, so let me continue. Reduced exposure to technology. Tech exposure has fallen from about 20 plus percent to around 10% today. I'm referring to his own portfolio, of course. And the reasons for that is, according to what he says, valuations, first of all, have risen significantly. Many tech businesses have actually become more capital intensive, right? And this is true. We see this, for example, with the Magnificent Seven companies. And Terry Smith owns, for example, Meta. He owns Microsoft. He owns, what else does he own? I think he owns, yes, he owns Google as well. And so these companies used to be capital light. They used to be capital light, but if you look at the cash, if you look at their if you look at the cash flow statements right now, guys, they are spending a ton of money on capex. If you look at the capex as a percentage of sales and operating cash flows, you can see that they are well above, for example, my preferred thresholds of 5% and 25% respectively. And Alibaba, for example, is one of these companies. It used to be certainly more capital light compared to today. So, I mean, however, However, unlike all these, unlike its Western peers, the valuations are cheaper, right? So the valuations have come down. Alibaba is trading at a significant discount still to its Western peers, right? So, and yes, I understand we have country risk, geopolitical risk. I understand that, but still, that big a gap, you have to ask yourself questions. These companies, these leading AI companies, continue to trade at nosebleed valuation levels while the capex has been ramping up, and we don't know whether those investments will turn profits. So either profits have to come back up, right, or the valuation needs to come back down. We don't know when the profitability will come, and so I think valuation should eventually, and they will eventually, come back down to more reasonable levels to reflect the capital intensity of these businesses these days. Okay, let's continue. Okay, so Terry believes tech may behave more cyclically in the next downturn, right? And this, of course, ties into what we were discussing here, because they are more capital intensive, right? And I think, for example, I think part of the reason why the US GDP has actually grown in the last quarter is because of AI investments. That is crazy. So we have all these investments in AI by large AI companies, by large tech firms that have been contributing substantially for the growth in GDP, which is crazy if you ask me. So in terms of position sizing and portfolio discipline, he never buys companies under $10 billion market cap. Why is that? Because if he does, he will end up owning more than 10% of the business, right? And he doesn't want to do that. And he also says he will never hold more than 30 stocks and never under 20 stocks. And positions are capped at 10%, which is mandated. Guys, this is an important reason. If you ask me, it's not the only reason. However, this is a huge disadvantage for a fund, if you ask me. And Terry Smith mentions that if he could, he would let his winners run, but they can't. And so the maximum weighting they can have in one single company is around 10%. Think about that. So even if it's a great business with plenty of reinvestment opportunities, growing very fastly, and still valuation is compelling, if it goes beyond 10%, he's going to have to cut. He's going to have to trim his position, and that is a big drag on performance, if you ask me. Because never cut. You want to make sure that you let your winners run, and you cut your losses short. Okay. Fortunately for us retail investors, we don't have these advantages. Size positions based on conviction. Okay, so we do the same, of course. Without the cap, Terry says they would happily let winners run much further. Very important as well. In terms of cash and earnings, AI is unpredictable, right? And Terry avoids businesses where outcomes cannot be forecast with reasonable confidence. And this is why Fundsmith focuses on cash flows, not accounting earnings. Think about depreciation and capital intensity matter. Meta, what they mention here, and the interview actually flags this, is that certain companies are lengthening their um, they are lengthening the they are lengthening the lifetime of their data centers. Okay, and some of them are actually shorten. No, most of them are lengthening them. When, for example, 6 years, 7 years, when you know the lifetime is about 3 to 4 years, and what that does is it causes depreciation, right? It just it by doing that, what that does is they are manipulating, in effect, depreciation, because what that does is it allows them to as I mentioned right here. Let me go. Let me go here to the document. Where is the document right now? What the heck happened, guys? Uh, I don't know what happened. Let me. Oh, is right here. Sorry. What that does, as you can see, depreciation in capital intensive. Yeah. So when they do that, what happens is depreciation is not fully reflected, and that causes earnings to actually be better, to look better than they actually are. And so this can create a lot of accounting manipulation, which is one of the things that some investors the big short investor, what's his name, Michael Burry, have been flagging, is that they are manipulating by lengthening those life cycle of the data centers. They are in effect distorting earnings, and they are making their appear stronger than they actually are. All right. And then Terry Smith says that you should always start with the numbers. Despite narratives, themes, and presentations, Terry made one thing clear: when analyzing a company, the numbers always come first. And he says that most investors actually don't even look at the reports. They prefer to look at these investor presentations, which only show you what managers want you to see. And in many cases, that includes, for example, non-GAAP financial metrics like non-GAAP earnings and adjusted free cash flows and so on and forth. That's why you should always look at the financials as well, because you can find a lot more interesting things in there. And as a long-term investor, those things should definitely matter the most. Okay, so guys, yes, I found it very, very telling. It's and I hope you managed to learn a lot and to find this insightful. That was certainly my case. And if you did, please smash the like button. Let me know in the comments below if you like Terry Smith as well, and what are some of these portfolio holdings that you may want me to analyze and why. And stay tuned for more, guys.